All right, guys, I got another one for you. This is crazy. This might be the coolest strategy I've ever come up with, and I'm pretty excited to execute on it. If it's done right, I mean, you could have compounding effects like you can't possibly imagine. MSTY, for example, could turn $9,000 into theoretically $4 million in 5 years if you executed on this perfectly and the stock continued to yield, $3-4 a share. It's not going to do that, right? So you have to, this is an active investing strategy. Like, you have to be involved with this. But dude, it's just, I can't believe how good the math works out on this stuff. And the fact that I'm just finding out about it is a bummer, because the Bitcoin cycle is likely halfway over at this point. The up year, for anybody that knows about crypto, the boom and bust cycles, and as soon as crypto takes a crap, MSTY is going to go with it. So this, we can't use that one forever, but we can use it for now. But anyways, so this is going to be a long video, because I'm going to try and teach you guys how this works and make it as beginner friendly as I possibly can. But these three ETFs that I have in front of you, MSTY, and I'm going to show you this because it's going to be alarming to look at, right? So down 31% past year. And then we got this one. This one looks the worst. Down 60% on the year. I'll explain. That one's a bit of an exception though. And then I will show you this one, down 32% on the year as well. So you can see they all decay, right? Like, they all do nothing but go down. But here's the kicker. Each of these yield and dividends crazy sums right now. And the distribution rate changes. But I looked them each up before this video. MSTY's current distribution rate monthly is 90%. 90% at these prices, which means that you're roughly yielding about $1.40 per share of MSTY that you own right now. And it changes. I've seen them as high as $4 this year, which is nuts. Okay. And what that means is no matter what the price is, you're getting paid that many dollars per share that you own. So if you invested $10,000 into MSTY today at $21 a share, and the yield paid $1.40 per share, right? So let's just, I'm not going to screw this up. I'm going to do the math here for you. So what was the price? It's $21.34. Okay. So, wait, we got to do $10,000, what I said, right? Divided by 21.34 gives you 468 shares times $1.40. So you would make $656 a month to own that stock. Let that sink in, right? So you're getting paid in dividends $6,000 something in a year, almost recouping your entire investment in a year. So even though the stock is decreasing, right? So let's say it goes down another 30% from here, you still end up with a net gain of $2,000. So that's nuts. But where it gets crazy is, right, this is where the strategy just gets nuts. And this is one example. I'll show you the other ones in a second here. But so typically with dividends, you reinvest in the same stock to keep, compounding your position size with something like SDHD, right? So this is a safe investment. Let me find this. SDHD, right? Schwab US Dividend Fund pays, the holdings are Coca-Cola, Verizon, blah, 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 all safe, steady dividend investment funds. It gives you about a 4% yield monthly, right? Or it ends up at like a 4% yield per year, and it averages about 11% a year. So, you're getting a 4% income every month and getting 11% growth. Great, safe, solid investment. That's where you should stick your money. But hear me out, okay? These give you crazy amounts of income, right? And if you time your purchases correctly, and this is where it's very important to have drip off. You have to have your dividend reinvestments off. And I'll tell you why. Like, you don't want it to decide when you buy them. You want to decide. So, all right. So going back to our MSTY example, right? We look the last 3 months. It's actually been relatively stable, holding around this price. Like, it dipped down. It dipped down to $17 during the peak of the tariff fear, right? And then recovered right back to 21 bucks. Pretty much held this line. We're flat over 3 months. Down 9% the past month. You know, again, down 30% on the year. But hear me out. Okay. So the key is, you know that this thing is just going to keep going down because that's what it does. MSTY is kind of the exception because it moves with Bitcoin. So let's look at YieldMax. This holds all of the high yield ETFs. So this shows you how they get all their yields right here, right? But basically it's just a collection of a bunch of high yielding ETFs. But if you look, down 2% the last 3 months, up on the month. I hate Robinhood because it doesn't let you go. Can I change this? Weeks. No, it doesn't help me none. All right, well, anyways. Point being is, for periods of time, about 3 month intervals, and of course it fluctuates, right? But the stock, you can see it's pretty stable. Hasn't moved at all over 3 months. So in that 3 month period, you generated, in this case, this one yields like 88%. So it's about, I think it was like 20 cents a share when I looked it up. That was the yield. So let's go back to our scenario again. We'll do the $10,000 scenario again. So $10,000 times, or divided by 1375 gives you 727 shares times 0.20. Yeah, and these are weekly, right? So this is, you're getting paid $145 a week. So let's go back to monthly again. So 145 times 4, right? And we said it was flat for 3 months. We just looked at that. It's flat over 3 months. So times 3. So you made $1,745 to hold this stock for 3 months. And it went nowhere, right? So then instead of reinvesting in it, you use this as an income stream. That's why this is crazy. Just basically kiss your initial investment goodbye and understand that over time, your yields are going to fluctuate. But generally speaking, you're always going to have a high yield. And you just have to accept that there's going to be decay on your share price over time. But eventually you recoup your original investment. If you hold it long enough, you will. Doesn't matter, right? So, all right, so you have to understand how this works. It's an income stream. What I'm telling you, I'm not saying it's spend 10 grand. That's a lot of money, right? But you use the dividends generated from this to then invest in something like SCHD or something stable, right? Like if you're growing a steady portfolio. If you are investing in this with you have a recurring investment every week for, I don't know, $100 or whatever, right? So $100 every week for 3 months, we figure out that's for 3 months, $100 a week for $1,200, right? And I just showed you that you could make $1,700 for holding that other stock that went nowhere, just flat. So you created an income stream. You created money out of thin air, basically, from doing that. And then you're going to say, well, why wouldn't you just stick it in here and buy it? Well, because that's not dollar cost averaging. And you're also creating money out of thin air. You're not spending your money on this way. It's another income stream. It's insanely powerful. This could be an exceptionally good strategy. But the main reason you want to have dividend reinvesting turned off is because you know these are going to fall, right? Like we can see most likely, I don't want to use this as an example because that follows crypto. So if you don't understand Bitcoin, don't touch MSTY, because if you don't know the cycles, you're going to get smoked on that. But like YieldMax, right? This is like all sorts of different stuff. It's got Amazon, let me see, Snow, TSM, ARK, Gold, Miners, Meta, Google, Moderna, XYZ, Netflix, Amazon. It's just a bunch of like covered call strategies. And then ULTY does it with option strategies. So ULTY has a higher yield than YMAX, but also is more risky and more volatile because of it. But regardless, since they've gone to weekly, ULTY is actually pretty good. So this is the one I'm probably going to pick to do this with. It looks terrible there, I know that, but they didn't switch to weeklies until like right here. And you can see the stock stabilized pretty much since. So super enticing. But anyways, so you know these are going to decay. You know they're going to decay, right? So if you have automatic reinvestments on, your average is actually going to end up worse because you reinvest every week, because ULTY, for example, pays out weekly. So you reinvest the dividends every week, you're just buying at the same price. But if you hypothetically, right, you should keep a certain percentage of your account cash all the time, right? So you take a chunk, right? So let's say you establish your initial position for, just for the same scenario again, $10,000 in ULTY. Okay. You generate $1,700 something dollars or whatever. Again, this is all, I'm just throwing numbers out of thin air, but you have to understand the theory here. So you generate $1,700 over 3 months. Okay. $10,000 initial investment. Stock drops one more leg down. Now you're down, let's say 12% on your initial investment, but you've still got a net positive, okay, of $500, which you've been investing in dollar cost averaging into another stock that pays a dividend and also grows over time. So you get a compounding effect there. Then you take your cash on the next leg down or a big dip, right? And you buy this, and then it recovers. So you end up averaging down. You get more shares, which results in higher income stream, right? So this has a compounding effect over time. That's how dividends work with anything, right? But you have to be strategic with when you buy ULTY. But again, look at over 3 months. It's down 1.43%. This pays weekly. It pays you weekly, okay? So you can get out of it. That's the other thing, is you can set a stop loss on this too. Like, okay, I want to collect income on this thing, but I don't want to lose my ass on it, right? So I'm willing to risk 10% of my initial investment. I'm willing to risk $1,000 on this thing, okay? So you buy it here. You set a stop loss, right? So you go trade. Well, I don't own any, but you go trade, sell, and then you would set a stop loss for 10% under the 621 price, which is, I don't know, 62 cents cheaper than this. So 560, 560 something, right? I would probably give it a little more room than that with something like this, because again, it's very volatile. But you could do that at $2,000. Let's say, okay, I'm willing to risk $2,000 to generate income, but you're risking $2,000, and within 4 months, you would offset your entire risk by collecting dividend income, assuming it didn't drop 20% in 4 months, which it most likely won't. If you can see here, in 3 months, we've dropped 1.43%, and that's through tariff fears, okay? Like this huge dip here, which was, we were up 8% down to negative 13% at a point, right? So that, it could have happened there, but that was peak tariff fear, weird, super sharpest, it was the sharpest downturn in market history, actually. It really was, ever, which is crazy. So you protect yourself there in that scenario. I mean, again, this is a risky strategy, but I'm trying to like relay to you guys that you can generate another income stream here if this is done correctly. And I'm probably being confusing talking so much, and I think the best way to do this is to actually make a series of like doing this. So I think I'm going to do that to show you guys how this works and just test it, right? And see how it does over time. But ULTY yields, let me see what it was. Sorry, I know this is a really long video at this point, but our ETFs, that was Ultra ULTY income. It is yielding 78.8% right now, which equates to 10 cents a share roughly. And you can see it's fluctuates, right? But between, damn, it was doing 46, 53. Well, that was when it was still monthly. Yeah, see, they switched to weekly back in March. Look at the payout dates. So the month, and then week. That's why they dropped off. All right, so 10 cents, call it 9. That looks like the median of this. I see some 8s, I see some 9s, I see some 10, but we'll call it 9 cents a share, okay, per week, right? So if I hold this, if I hold ULTY, and this is what I'm actually going to do. So I'm actually going to do this tomorrow, and I'll start the series, but I'm just going to show you guys the strategy. So I'm going to buy $5,000 worth of ULTY at 621. That gives me 805 shares. Okay, let me times that by 9 cents a share. That gives me $72 a week in income. Okay, so let me times that by 4. We're making $300 a month off of a $5,000 investment, which means inside of 1 year, assuming the yields stay anywhere close to that, let's see, times, what is it going to take? Not even 18, 17, yeah, so 17 and a half months. So in a year and a half, I would recoup my entire initial investment, and all the yield that I'm getting from that point on is completely free. Like, it's house money from there. So you just ignore that you're losing money on your initial investment. You have to ignore that. It's an income stream, okay? You are buying an income stream. That's how you have to look at it. Hopefully that makes sense. And this is a really long-winded way of saying so, but you have to understand how crazy powerful that is, right? That's like going and buying a rental property for $250,000, okay? And then you rent that sucker out. Let's say you paid cash, which most of us couldn't do that, let's be honest. You pay cash for a $250,000 rental, and then you rent it out for $1,500 a month. That's optimistic, but let's say it's possible, right? How long do you have to hold that rental? All right, so we just figured out you recoup your money in a year and a half, and it's house money after that, right? $250,000 house divided by, what did I say, 1,500? 166 months. So divide that by 12. So you have to hold that rental for almost 14 years before you recoup your initial investment. Until then, it's a liability. Like, you're down until then. 14 years. And I just showed you that executing this strategy, theoretically, right, there's risk, right? It's susceptible to huge downsides. Like you can see, from November to now, it's down 50%. But again, the yields are roughly the same that whole period of time. They were monthly before, now they're weekly, but it doesn't matter. It doesn't matter where you buy it if you hold it long enough, assuming it continues to get the yield. And the yields will dwindle. They will. And there's an expense ratio, right? And again, ideally you buy the dips. Like, that's how you really make this work, is you buy the huge drops. You have to buy them. You have to, because that really makes it powerful. Because then you get some upside too, because it never drops in a straight line. Down to 838, then up to $9 almost. And then boom, let's see, okay. But you can see since it's gone to weekly, like remember I showed you earlier, they switched in March. So we saw a big plummet. And ever since we got into weekly distributions, we've basically been flat, which makes this, that's why I'm super enticed with this one. It's a lot easier to manage and mitigate risk because the dividend payouts are weekly. So it's a lot slower price movement, which makes it easier to take care of. Again, I'm going to make a YouTube series on this. I hope I'm making a lot of sense, but basically you're buying an income stream just like you would with a rental property. And it doesn't even matter what it's yielding at the end of the day. Once you return your money, let's say that it goes from 9 cents a share a week to 4 cents a share a week. Who cares? It's free. Like you're literally just spawning money out of thin air at that point because you've already recouped your initial investment in dividends in a year and a half, and now you're making 4 cents a share. So you're cutting that 17 or whatever. What did I say? It was $5,000 over 17 months. So you do in the same time span. If it got cut in half, if the yield got cut in half, you'd still make $2,500 out of thin air, right? And this is small amounts of money. So obviously if you buy more, you get my point. You get my point. It takes management. It takes monitoring it. It takes risk tolerance. It takes being able to stomach volatility, right? Like this, I mean, it's crazy. It's crazy. In MicroStrategy specifically, this yields 134% right now. At its peak, it was paying $4 a share a month. So if I bought a share of this, I was recouping 25% of my investment in 1 month. Like that is just bonkers, right? So I got to get some of this because we're in the Bitcoin cycle and it's volatile as hell. You can see that. But right now it's at a low. It's towards the low. It's down below. Pretty much if you buy it under $25, you're pretty safe. And the yields, this has the highest yield of all YieldMax ETFs. It's like, what was it? I think it's 100 and I think it's at 90% right now, but it's all based on the volatility of MicroStrategy, which MicroStrategy's underlying asset is Bitcoin. So basically how if Bitcoin starts moving and fluctuating a lot, then MSTY will do the same. Oh, where the hell's it at? MSTY. I believe it's 90% right now. Yeah, 90% distribution rate. But look at the payouts. So that's just wonderful. But you can see $1.40 was over $2 there. If I turn it, I don't know if it's just record right, but I mean you can just see. At one point I was paying $4.50 a share for a month. Like that's just it's crazy. It fluctuates like wild. But if you buy the lows on that one, dude, I mean it's gonna print money, right? But I wouldn't go crazy heavy on that because it's crypto. Crypto's I don't have the stomach for that kind of loss. I've done it once and I don't want to do it again. But some people can take it. And if you were to buy MSTY heavy, I'd probably buy in like a bear market and just wait and sit on it until crypto has another cycle. So if assuming the 4-year cycle theory is still true, that would mean 2028 is when it would start moving again. 2028, 2029. So you buy heavy in like early 2027, right? But we don't know if that's true anymore because now crypto's involved with the SEC and we have a Bitcoin reserve and all this other shit. So theoretically, crypto could stabilize here and actually become like gold. It's really hard to say. So it's like part of me wants to just dump a ton of money in it, but part of me is like, screw that. So maybe as I grow the account, I'll average into this. Depending on how it works, how it does over time, and I monitor it, I'll make that decision, And I know I've seen people have like dumped their entire Roths into this, and inside of 4 months done 160% return. It's kind of crazy. The stock market's never seen anything like these YieldMax accounts, and I've been doing a lot of research on them, and it's pretty interesting stuff. You got to understand stocks a little bit. You have to understand how dividends work. You need to be able to manage your positions decently, right? So this is not what I would call a beginner-friendly strategy. But if you want to learn how to do it, like I said, I'm going to make a YouTube channel where I just do this, like I guess like a weekly update on it and how since the dividends are going to pay weekly, I'll chart it over time, and maybe weekly is too frequently. I don't know, maybe I should do monthly, but I'll start with weekly and we'll see how it goes. But yeah, you can basically buy yourself income streams if you do this right. Just like buying rental properties, which is pretty freaking wild. And it doesn't really matter what the return is after that point, does it? This one is really enticing because it actually sees upside. Like, that's the thing, is it fluctuates. MicroStrategy is at like 390 right now. Its price target for the end of the year is like 500 something. So assuming that's even close to accurate, we should see this get back to like at least this range somewhere, like $30, $27. I think price target on MSTY for the end of the year is $27. So you're actually under target right now, and you're getting a 1.4 to $2 yield per share, like per month. I mean, it's insane. It's freaking insane. It's just, there is nothing like it. It won't be around forever. It will not. This is not something you're going to be able to do all the time. So while it's here, while rates are high, while the crypto cycle is going, while this is still a thing, yeah, I mean, you got to take advantage of it. You got to. And I will teach you guys how to do it, and I'll show you my strategy when I start tomorrow. And yeah, I hope this video enjoyed you. Oh my goodness, sorry, it's 1:30 in the morning. I hope you guys enjoyed this video, and I hope you learned something here. If you have any questions, please let me know. I know it's a bit confusing, but the moral of the story is, depending on how you go about this, in between a year and 2 years, you could recoup your entire initial investment into this ETF and basically be generating passive income for free from therefore on, which is like what you would do with real estate, except you're doing it in about 1/10 of the time. 1/10 to 30 years less of the time. If that doesn't get you excited, I don't know what does. But, All right. Y'all have a good one. See you later.